It's time now to look at the derivatives diary and figure out what the open interest and the F&O market is telling us. Remember, we had a gap up opening rather in the trade today, and there was a bit of short squeeze that happened yesterday as well as today. Shorts got trapped, but if you look at the open interest, there was a mild buying that happened, a change in the open interest of just around 0.5%. Moving on to Nifty Bank then, because there as well there was a bit of mild covering. That index had been seeing quite a bit of open interest build up. Today we saw that there was a tad bit of covering with the open interest going down by around 1%. Tracking the India VIX then, because as we told you earlier as well, there has been some reduction as far as the volatility is concerned, and India VIX will tell you that it has come down to around 25 times. Moving on to the other levels that we are tracking, as far as the March 17th expiry is concerned, which is the next week expiry after what concluded today, the active levels that we are tracking is 16,000 as well as 16,200. Saw some put writing telling you that there is a base formation that has happened at around 16,300 and 16,400, and 16,000 becomes a very strong support level for the markets. Moving on to active put levels as well, which is around 16,000 as well as 16,200, wherein we saw some put writing. On individual counters, there was quite a bit of long build up as far as Berger Paints is concerned, a 15% open interest there, and Colpal also saw an open interest build up of around 14%. On the flip side, however, there was a short build up that happened on the likes of Coforge as well as Gujarat Gas. For Coforge, remember, there was a block deal today, so we need to take into account that as well. But Gujarat Gas is something which has been quite active on account of the gas price movement that we have been seeing. So keep a track on that particular counter. Short covering is something that we saw on the counter of L&T Tech. So that should be on your radar. And Scott saw a very interesting move today with the futures being at a premium versus the cash market of around 1800 versus 1667, and that is perhaps on account of the special situation of open offer which is lined up. Lastly, talking about the unwinding, and that is something that we saw on the counter of Manappuram, so that is something that you need to have on your radar as well. That was about the derivative setup of the market, but what was the key story of the day? Well, autos was one space that was definitely zooming ahead in trade. My colleague Shrishti has done a 360-degree analysis in terms of what the correction has been so far, what are the key levers which are available for these counters, and more importantly, how the stock valuation has become now. Let's go across to her.
The trend was quite clear just 1 month back in the auto counters, where we were seeing a gradual recovery happening in the passenger vehicle and commercial vehicle space, and these stocks were actually holding up. But the picture has actually flipped since 25th of February, the time the war broke out between Russia and Ukraine. Indian auto stocks have corrected anyway between 4 to 20%, and we all know the reasons why. The recent surge in the commodity cost inputs, along with that crude is also on the boil, up 30% in the past 1 month. Along with that, there are issues again hovering around the chip shortage situation, because some of the key inputs used in the manufacturing of these semiconductors were used to get in from Russia and Ukraine. All of these factors are building in, and the stocks have actually corrected. But now the question arises, is the worst is over? But while talking to the analysts, they do highlight, they don't know whether or not the worst is over, but this is definitely going to impact the near-term earnings for all these auto companies. But the longer-term picture is still rosy. They do say that the recent correction does offer good buying opportunity with 1 to 2 years perspective. Getting the chart on the screen, if we see, the valuation comfort is also visible. Comparing the 5-year average PE to the 1-year forward PE, then that actually seems to be trading at quite cheap valuations. Along with that, getting you some of the brokerages intakes as well. Jefferies do cut their FY23 EPS estimate by 7 to 45%, factoring in the commodity cost inflation, but some of their preferred picks are Tata Motors, Morgan Stanley, TVS Motors and Ashok Leyland. And along with that, JP Morgan is also quite positive. They have recently upgraded Ashok Leyland to overweight from neutral rating, upgraded Maruti to neutral from an underweight, and their preferred picks are Ashok Leyland, Bajaj Auto and M&M. And they also highlight that FY24 core PE at 10x is close to long-term bottom. So definitely the near-term pressure still persists. The picture is still unclear, but a good buying opportunity from 1 to 2 years of perspective.